Would you believe if I told you that inflation, the thing we're told hurts everyone, is the same force that quietly makes the rich even richer? Inflation is defined as a general increase in the prices of goods and services in an economy. This increase corresponds to a decrease in the purchasing power of money. Inflation affects everyone in the economy to some degree. However, the impact of inflation is not uniform across different income levels. Real estate values generally tend to increase during periods of inflation. This increase is due to the rising cost of materials and labor involved in construction. As the cost of new construction rises, existing properties become more valuable. Wealthy individuals often hold multiple real estate properties as investments. These individuals benefit significantly from the appreciation of property values during inflation. Real estate can act as a hedge against inflation, preserving and growing wealth. Stock prices often increase during periods of inflation. This rise is driven by companies increasing prices, which leads to higher profits. The wealthy tend to hold a larger proportion of stocks. Therefore, asset appreciation disproportionately benefits wealthier individuals. Commodities like gold, oil, and agricultural products often see price increases during inflation. This increase is due to their perceived value as a store of wealth during economic uncertainty. Wealthy investors frequently use commodities as a hedge against the devaluing effects of inflation. The limited supply and intrinsic value of commodities contribute to their appeal as inflation hedges. As currencies lose purchasing power, commodities tend to maintain or increase their real value. Wealthy investors often use debt to finance real estate acquisitions. As inflation increases, the real value of this debt decreases over time. Simultaneously, real estate assets tend to appreciate in value during inflationary periods. This combination allows investors to realize gains as their debt effectively shrinks and their assets grow. Wealthy business owners can strategically utilize low-interest loans to fuel expansion. Inflation reduces the real value of debt over time, making loan repayment less burdensome. Businesses can repay loans with cheaper money due to the decreased purchasing power of currency. Simultaneously, business profits can increase, further easing the debt repayment process. Wealthy investors often utilize financial instruments to safeguard their assets. Treasury inflation-protected securities, TIPS, are one such instrument. TIPS are designed to protect investments from the adverse effects of inflation. The principal of TIPS increases with inflation and decreases with deflation. This adjustment helps maintain the real value of the investment over time. TIPS offer a degree of financial security against the eroding power of inflation. Real estate investment trusts, REITs, offer a potential hedge against inflation. REITs primarily invest in real estate properties. Real estate values and rental incomes tend to increase during inflationary periods. This increase can help REITs maintain or grow their dividend payouts. Wealthy individuals often use REITs as a tool to preserve capital during inflation. Hedge funds employ advanced strategies to capitalize on inflation. These strategies are designed to generate profits from rising prices. Access to hedge funds is generally limited to wealthy investors. Average investors typically do not have access to these investment vehicles. This exclusivity is due to high investment minimums and complex regulations. Hedge funds offer sophisticated methods for managing and profiting from inflationary environments. Wage stagnation refers to a prolonged period of little or no growth in real wages. For lower-income individuals, wages often fail to keep pace with inflation. Inflation erodes the purchasing power of stagnant wages. Reduced purchasing power means essential goods and services become less affordable. This financial strain makes it increasingly difficult for lower-income individuals to save. Limited savings can hinder long-term financial stability and economic mobility. Lower-income individuals often have limited asset ownership. This lack of assets means they cannot benefit from asset appreciation. Asset appreciation is the increase in the value of assets over time. Inflation erodes the purchasing power of money, but assets can maintain or increase their value. Therefore, limited asset ownership leaves lower-income individuals vulnerable during inflationary periods. Inflation causes essential goods and services to become more expensive. These essential items include food, housing, and transportation. Rising prices disproportionately affect lower-income individuals and families. Lower-income households spend a larger percentage of their income on necessities. This makes them more vulnerable to economic hardship during periods of inflation. Inflation reduces the purchasing power of money over time. This erosion disproportionately affects lower-income individuals. Lower-income individuals often have limited savings and investment options. Inflation makes it more difficult for them to accumulate wealth and achieve financial stability. Inflation tends to perpetuate existing wealth disparities. Wealthy individuals often hold assets that appreciate in value during inflationary periods. These assets may include real estate, stocks, and commodities, which can outpace inflation. This appreciation further increases their wealth, enabling more investment and asset accumulation. Conversely, the poor often see their purchasing power diminish as wages fail to keep pace with rising prices. Tax policies can unintentionally worsen wealth inequality, especially during periods of inflation. Inflation erodes the purchasing power of money, impacting lower-income individuals more severely. Certain tax structures, such as capital gains taxes, can favor wealthier individuals who hold more assets. Capital gains taxes are often lower than income tax rates, benefiting those whose wealth is primarily in investments. This disparity can further concentrate wealth, exacerbating the gap between the rich and the poor during inflation. Monetary policy, particularly interest rate adjustments, plays a crucial role during inflation. Raising interest rates can curb inflation by reducing spending and investment. However, higher interest rates can disproportionately affect lower-income individuals and those with debt. Increased borrowing costs can strain household budgets and limit access to credit for the less affluent. Conversely, lower interest rates can stimulate economic activity but may also inflate asset prices, benefiting wealthier individuals who own more assets. Therefore, monetary policy decisions must consider the potential impact on wealth distribution during inflationary periods. Inflation significantly impacts the housing market by increasing the cost of construction materials. Increased material costs lead to higher prices for new homes, making them less affordable. Rising interest rates, often a response to inflation, further increase the cost of mortgages. Higher mortgage rates reduce purchasing power, especially affecting lower-income individuals. Consequently, inflation exacerbates housing affordability challenges for many potential homeowners. Inflation can influence the stock market, creating both opportunities and challenges for investors. Rising prices may lead to increased revenue for companies, potentially driving up stock values. Wealthy investors who typically hold a larger proportion of stocks may disproportionately benefit from these increases. However, inflation can also erode purchasing power and increase operational costs for businesses. This can lead to market volatility and uncertainty, impacting investment strategies. Wealth inequality can be exacerbated during periods of inflation. Progressive taxation is a potential solution for mitigating this effect. Progressive taxation involves higher tax rates for higher income brackets. Wealth redistribution policies can also help reduce wealth inequality. Inflation's long-term effects significantly influence wealth distribution. It can exacerbate existing inequalities if not properly managed. Understanding these mechanisms is crucial for policymakers. Effective strategies are needed to mitigate inflation's unequal impacts. Promoting a more equitable society requires addressing inflationary pressures on wealth.